Watching Ask BQ on BQ Prime. My name is Alex Matthew. This is the return of a show that a lot of you are familiar with. And as the name suggests, it's a show that gets you answers to all of your stock related questions. So, over the course of the show, do send in all of your questions live. I'm joined in live on YouTube, and we will soon have a WhatsApp number running as well. But for now, if you can tune in on WhatsApp and ask all of your questions live, that would be great. We will start with a segment every day that focuses in on a particular stock or a group of stocks that is very active in trade, and then we'll start taking questions. Let me introduce my guests for the day. We've got Dharmesh Kant, who's the head and equity derivative research at Chola Securities, and we've got Nilesh Jain, who's the head AVP technical and derivatives research at Centrum Broking. Thank you so much, guys, for taking the time. I think I might have gotten Dharmesh's designation wrong, but he's at Chola Securities. Dharmesh, thank you so much for taking the time. Let's start with a conversation about HDFC Bank, because this is a stock today that has almost single-handedly pushed the Nifty back below the 20,000 mark. It's down about 3.8%. And a few headlines coming in from that conversation that the management had with sell-side analysts earlier in the week. And that has to do with a few key parameters. One, of course, is the asset quality, which is expected to take a bit of a hit. We're also expecting net interest margins to contract a little bit. And all of that has to do with the amalgamation or the merger with HDFC. What are your initial thoughts about these headlines, and how should investors react?
Hi, Alex. Good morning. So this was always there on the cards. I mean, this analysis was already there that after the merger, there would be a hit on the net interest income and IMs and the asset quality. There would be some provisioning happening out there. But when it is printed in black and white, then it makes all the difference. And this is what we are seeing today. Because when it comes out from the horse's mouth itself, then it's a stamping on what the thesis was already there. So, I mean, my biggest fear with the bigger banks like HDFC or SBI is that the growth part, when it comes to the growth of these banks, so particularly what we have seen is it's the retail and the unsecured portion which has been driving the credit growth market of late. And the corporate growth has not been there, and even if it is there, it would be a low single digit kind of a corporate growth because most of these companies are flush with funds. Their internal accruals are very high and they don't need debt for their capacity expansion. Whatever they need is more of a working capital kind of a requirement, and which is not very high as of now. Going forward with the type of size after the merger HDFC Bank would be setting on, it would be difficult to maintain a growth run rate of around say 18 to 20% on the AUM side, that is the trade growth. At the same time, the margins will definitely take a hit because the deposit base has not been expanding as fast to maintain a growth of 15%. So they need both in place, and most of the NBFCs has taken up the low ticket home sales or credit growth or unsecured part of the business. So there's the challenge out there. So this was there in the offering. What I think is for next say 1 year, HDFC Bank will be an underperformer to the market. It may not correct more because still they are sitting on the strong fundamentals. And ROE 15-16% is a given for HDFC Bank. Asset quality will remain impeccable. Maybe for this adjustment, 10-20 basis point hit can be there. But thereafter, it should stabilize from there. Only part is the valuation part. Though it has come down, I mean, it would be right now trading at 3 times price to book on a TTM basis. But going forward, I think it's likely to correct to around 2.2 or 2.1 times post the merger happens. So that is where the
So the question, I think we've already got one question. And so the most important question with HDFC Bank, of course, is, and Bala is asking, should we buy or sell HDFC Bank? That's a very simple question. I think everyone's thinking about that right now. You said it, right? These murmurs have happened over the course of the last several months. This is coming from the horse's mouth. Would you say that you should still hold on to HDFC Bank if you are invested? Should you take these opportunities to add to your holding? That is something that has happened in the past. Valuations compared with historical averages have fallen. Or would you say that you're better off shifting to something like an ICICI Bank or maybe even a State Bank of India or a Kotak?
It's better to switch. I mean, it's time to sell HDFC Bank if you have not done earlier, because we were of a very clear view that the twin should not be in the portfolio as far as long-term fundamental view is concerned, because there are plenty of other options which are available in the same space where you can have a better delta. So ICICI Bank or Axis Bank does have a better delta than HDFC Bank, and even for that matter, SBI, because SBI is still the valuation. What I believe is this all public sector banks will eventually catch up with the valuation matrices of private sector banks. So there's a catch-up value which is bound to happen. It's already started, it's in the process, but going forward, there would be almost at par with the valuation multiple of private sector banks. So there even SBI has a bigger chance. So four banks which I would like to highlight here, if investors want, they can switch to them. Two from the private sector, that is ICICI and Axis, and two from the public sector space. One is SBI and the other one is the Bank of Baroda.
Fantastic. All right. Just a quick reminder to everybody tuning in. If you are on YouTube, then you can send your queries on the chat function at the side. I'm there as well, and so I can talk to you directly. In the meanwhile, why don't I go to you, Nilesh, on the banks that Dharmesh has also mentioned. First, let's talk about HDFC Bank and the key levels to watch. But since he has given recommendations for Axis as well as ICICI and State Bank of India, why don't you tell us the best levels to look at for those as well?
Hi, good morning, Alex. Well, if you look at the HDFC Bank, today it has given a big gap down opening and also given a breakdown from its key moving averages, that's 21, 50 and 200-day exponential moving average. So all these three moving average has been broken in today's trading session. So certainly that is giving further follow-up selling might be coming in the coming sessions. So overall, as far as levels are concerned, I feel that the stock might test the levels of 1500 going forward in the short run. So it is not advisable to take any contract at current level and better to avoid. The better options are available from PSU banking space. I completely agree. State Bank of India continues to remain our preferred bet from the public sector bank. We expect further upside momentum to continue for the upside target of 620 to 650 in the near term. The stop loss should be placed below 585 from trading point of view. Apart from that, Axis Bank, which is constantly hitting fresh all-time high levels, and the structure is still hinting that the stock has a potential to move towards 1100 mark. So if one can buy on decline and buy in a staggered manner, and the stop loss should be placed below 980. The ideal buying range should be 1000 to 1020. So Axis Bank and from PSU banking space, State Bank of India continues to remain our preferred bet.
There's a follow-up question, this one from Subramanian P. He says that he's a long-term investor in HDFC Bank. Should I worry now or wait for the quarter results? Dharmesh, I think that's an important question. One, we've been talking about what could pan out, but we've not seen it in black and white yet. Would you wait for the print?
No, I won't wait for the print. I mean, the view is very clear. Our direction is very clear. There will be a deterioration on the NPS side, on the net interest income, net interest margin, and the profitability. Even book value is going to take a hit going forward. So that means there is some provisioning which will be accounted for in the next quarter earnings, and that will take a hit on the book value. So it's better to sell it now, because even if it stabilizes, I don't see a good price action going forward. So, I mean, if you, at the same time, if you invested in the stocks which we mentioned, like Axis, ICICI or SBI, one can get a better return than holding on to HDFC Bank.
We've got a question live from Anand Sivaguru, and he's asking about the best options in the diagnostic space. And interesting, right? Because Dharmesh, earlier in the week, we saw a headline that said the online diagnostics companies are raising their prices. What would you say about the players in the space, and which, according to you, are the best picks?
The prices was, I mean, that was a natural course of action which was about to come, because initially to gather the market share or garner the market share, the price cut war was there. But now, since it has stabilized and now people have realized that to be profitable is more salient important than to have the market share. So just things will happen. I mean, all the diagnostics players are good, but particularly if you say, I mean, as SRL one can go around with, or maybe the Metropolis. So those are the two spaces where we think still there is a good upside traction. But overall, the entire space looks attractive to me after the price dropping which we have seen in the last 1 year or so.
Now, we did speak about a few banks. We've got a question from Abhishek who's asking about Punjab National Bank. And he's saying that it's run up over 60% over the last 6 months and showing quite a bit of strength. On the charts, though, Nilesh, what's the view on Punjab National Bank? And would you suggest that if someone is holding on to take these opportunities to book some profits, or would you suggest that it's still going strong?
We have been bullish on the PSU banking space since we have seen a good breakout on the Nifty PSU Bank Index chart. So overall, all the PSU stocks are looking positive, and this momentum might continue from here as well. So specifically from in the PNB stock, if you look at it, it is constantly forming a high top and high bottom formation. So I would advise to keep a trailing stop loss near about 72 and stay put for the upside target of 80 to 85 in the near term. Overall, within PSU banking space, as we mentioned and discussed, State Bank of India continues to remain a preferred bet. And if somebody is looking for a smaller bank, I would rather suggest to go with Bank of India. We have seen a multi-month breakout in this particular counter, currently trading at 110. It has a potential to move towards 120 to 125. So this particular counter can also be bought at current level and on decline, keeping stop loss below 102.
Okay. A question then on the wider public sector bank space, because we saw on Monday, Dharmesh, that Indian Overseas Bank hit an upper circuit at one point, 20%. It gained about 15% for the day. There were a few large trades. But then how do you react to this kind of movement? Is it necessarily reflecting a change in the fundamentals?
See, one fundamental change is that the asset quality of all these public sector banks have improved drastically. And now, with the type of economic trajectory and growth we are seeing, the momentum which is there in the economy, this asset quality is stable. It has likely to remain stable and good for the foreseeable future. Secondly, all these banks have revamped themselves and they are more on the lines of how the business has to be done in line with the private sector banks. So they have become aggressive and the sell point, the B2C point has improved quite significantly. So what I believe is the re-rating is happening on the valuation part rather than on the business part. So business is catching up with the private sector space, but the more catch-up or the aggressive catch-up has been done on the valuation part, where all these banks are likely to get price to book value multiple near to or close to all the private sector peers. So that is where it is happening. And the second thing which Alex is there is the banks like the Indian Overseas Bank and all, they have a very few liquidity float. I mean, the liquidity levels are very less when you come to buying. So even a good some fund is going to buy that of few HNIs, they decide to buy or zero in a particular public sector bank. So because of lack of liquidity, the price surges far higher. So one has to be mindful of that fact. But stick to the larger public sector bank basket rather than going into the smaller ones.
Quick view, Nilesh, on the wider public sector banks, and point well taken, Dharmesh. Stick to the larger ones. But then we've seen a lot of price action in the recent past on the smaller names as well. And incidentally, IOB became the third largest public sector bank by market share on Monday, overtaking Punjab National Bank. Nilesh, what's the view on the wider space, public PSU banks?
Overall PSU banking space, the view is clearly on a positive side. We have seen a good momentum in last 4 to 5 weeks now, and this momentum might continue. So specifically, few names from the index heavyweight, Canara Bank, BOB, State Bank of India are looking positive. And smaller names, I would rather go with the Bank of India. So that particular counter is purely on the technical parameter. It has given a good breakout, multi-month breakout. So it has a potential to move towards 120 to 125. One can buy on decline, keeping stop loss below 102. And apart from that, a few other names like PNB and also Union Bank, where we might see a further momentum to continue.
Okay. We've got a question on Anand Rathi Wealth, and this is for a viewer who's tuned in live on YouTube. Amit Rastogi is asking, what's the view on the long-term fundamentals? And Dharmesh, this is for you. It's a stock that is currently at close to 1,500, and this is a company that has committed to 20% growth consistently, and it has beaten that in the last financial year. It has beaten it in the first quarter of this year as well. What's the view on this? Would you suggest a fresh entry?
Alex, my sincere apologies. I would like to give it a pass on that because of business line means saying.
Okay, no, that's a fair point.
Yes.
Nilesh, would you be able to give us a view on the technicals of this counter?
Yes, I can provide a technical levels. So overall, we have seen a good momentum in this particular counter, and it is on the verge of a fresh breakout. The breakout is now placed at somewhere around 1500, which is hovering exactly near those levels. And looking at this momentum, I think this stock may continue to do well. From near-term point of view, the stock has a potential to move towards 1600 to 1650. So one can keep a trailing stop loss below 1420. And if somebody is looking to make a fresh entry, I would rather suggest to buy on decline, keeping stop loss below 1420 for the upside target of 1600 to 1700.
Okay. By the way, Amit, we'll try and get you a view on this particular stock, but then Dharmesh has a fair reason for not giving his view on this one. We've got another one, Renu Shah, who's asking about between hospitals and the other counters in the healthcare and the pharma space, which would be the better play from the fundamental standpoint? And pharma as a theme, Dharmesh, came back into the fray just about a month and a half, 2 months back, right? So what, according to you, would be the best way to play the space, and what are the top picks for you?
I mean, hospitals should be the best way to play this space because as far as, drug producers are concerned, or the pharma space, the prices have run up too fast. I mean, they are now fully priced, and even one standard deviation on the valuation multiple, they are trading on the higher side from the mean multiples where they used to trade. I don't think these valuation multiples would be justified in the near future for the drug producers based on the multiples where they would get a growth of around 10 to 12% on top line. Margins being stable, and that will translate to around 12-13% kind of a bottom line growth. Whereas these are quoting at anywhere between 20 to 30 times PE multiple 1 year forward. So there, I think correction or time correction is overdue. Diagnostic center, we spoke about Metropolis, but I think with the more juice or the more effective valuation gap is there in the hospital segment, and there Apollo Hospitals remains a topic because the different verticals where they are, like online pharmacy and the online consultation part, is going to pick up in a big way, and that would translate to a very healthier operating profit in the even on the bad side. Around 40 to 50% kind of a contribution is going to come from that. So I still believe if you are willing to hold on for 2 years, Apollo Hospitals can be a developer from here, just based on not only the hospital part of the business, but also the online consultation and the online pharmacy part, where they are growing very faster.
We've got a question from Victor, and look, we're going back to HDFC Bank, but this is an important point which we didn't raise. I think on the fundamentals, you expect that it will moderate a little bit on the valuation side, right, Dharmesh? If I remember what you said correctly, at what point does it become attractive again as a buy?
See, for it to become very attractive, either the valuation should drop very drastically, because when we select a company, it's for the growth trajectory when we are buying, and not for the margin of safety, just that it has dropped below the mean valuation multiple. And reversion to mean is not the kind of a play we enter. That's more of a trading play, not an investment play.
Sure.
So my thesis on selling HDFC or exiting from HDFC Bank was just on that the growth is going to moderate in a significant way. So with that, valuation will also come down, and sometimes market does excesses when it moves over or comes down. So that excess point will definitely be there in HDFC Bank itself. So just for a trading perspective, somebody is looking at, so anywhere between 1.4 to 1.5 times price to book when the valuation multiple is there. That is a good time to play a trade on that. But if you're looking at a long-term compounding, the way it has done for the last 20 years, for that, I think there are better opportunities.
Okay. We've got a question on Ethos Limited, and I believe that we've got Amit, who's asking about the long-term trends on the charts. So Nilesh, what is the long-term view for Ethos Limited, and what is the buying range according to you?
Well, if you look at the technical chart, the stock has been in an uptrend and currently trading somewhere near about 1755. The only concern is that it's slightly illiquid counter. We usually don't see much of a volume in this particular space. And looking at the overall setup, I feel the momentum looks strong, and we can expect further move to continue towards 1850 to 1900 in the near term. So if somebody is already holding the long position, can keep a trailing stop loss below 1660 and stay put for the upside target of 1850 to 1900. If somebody is looking to make a fresh entry, I would rather suggest to buy on declines and wait for some meaningful correction at current level and buy in the range of 1680 to 1660. The major support for this particular counter is placed at somewhere near about 1570.
Okay, fair enough. Akhilesh on YouTube has got a question on LIC Housing Finance. What's the view, Dharmesh, on this particular counter? And I'm actually curious because, again, we're talking about HDFC as the leading player in the mortgage space, moving into HDFC Bank. A lot of people talked about synergies at that point. So I was actually wondering why you're saying there are questions about growth. I know the point that you're making about corporate side, but in any case, in the lending space, most banks are anyway transitioning to the retail side, and unsecured is growing in a big way. Why are you saying that there are concerns about growth, and what's your view on LIC Housing Finance?
Yeah, so first question is like the unsecured part of the business.
Sure.
So as far as the unsecured part of the business is concerned, the norms for lending is very stringent when it comes to HDFC Bank or SBI because they are more, stricter as far as the giving the lending is concerned, and that's the reason why you get the borrowing costs for the people who is taking the loan is lesser when it is from HDFC Bank or an SBI. But unsecured lending is more to do with the high risk kind of a lending environment. So the people who come for that, they want it, they are ready to pay more, but they can't service the kind of requirement which these banks are looking for. So that is the reason why we are seeing most of the NBFC space are growing at 50%, 70% kind of AUM growth we are witnessing in the unsecured part. So that would be a challenge for a bank like HDFC to get that market in place. So that was my only concern out there. Credit card business is one business which has picked up well, but credit card has its own limitations as far as unsecured lending is concerned. So that's one of the way of doing this business. Again, what we have seen is a bigger traction in SBI or Axis Bank credit card business growth rather than an HDFC Bank. So that aggression, their own set of parameters which they have built in for giving the loans will be a key challenge or, would be locking their growth for the unsecured part. Coming to the next question, like LIC Housing Finance, companies like that in the NBFC space. So today we have seen some traction out there. And these companies are likely to do well. The entire basket is still likely to do well, both on the affordable housing segment side and as well as the mid housing segment side. So what we have seen is most of the booking coming on the premium segment where these companies don't have a much larger stake. But affordable with the current environment and my own sense of interest rate is picking out. It will peak out very soon for our country as far as India is concerned. So there again, the affordable housing segment will pick up. So there, Canfin Homes remains the top pick out there, followed by PNB Housing and LIC Housing Finance.
Okay, let me get a quick view on the technicals and then we'll shut for today. What's the view, Nilesh, on LIC Housing Finance?
Well, overall, in the NBFC space, the view is slightly on a positive side from a short-term point of view. So LIC Housing Finance, in last few weeks, we have seen a continuation of a higher than habit of formation. Structure looks strong, and if we take a view of near to medium term, then we can expect further upside move to continue towards 500 to 520. So purely from trading point of view, the stock has the potential to move towards 470 to 480. From position point of view, we can expect further move to continue towards 550. One can keep a stop loss below 440. And apart from that, within this space, the other stock that we are liking is M&M Finance, where today only we have seen a fresh breakout from a consolidation. So this particular stock can be bought at current level for the target of 330 to 340. Stop loss can be placed below 300.
Okay, fantastic. Nilesh, Dharmesh, thank you so much for joining in and for giving us all of those answers today. And viewers who've got your questions answered, I hope that this has helped you. And if you've got more questions, we'll be live every day of the week at 11:30. So tune in then. Thanks so much for watching. This is BQ Prime.
Thank you so much.
Thanks.